Let's get a check on how oil and currencies are trading. Joining us right now is Kevin Book, ClearView Energy Partners, from ClearView Energy Partners. Joseph Trevisani is here, senior analyst at FXStreet. Kevin, you heard what Brian had to say. Do you see anything on the horizon that would turn this around? And if not, what do you do about it?
Well, I think the bearish story is the leading story, because you've got not just the front risk where you can see where there's trade tensions, frictional loss of demand, but also the underinvestment that's happening in the background, right? So right now we've got seasonal second half strength keeping oil aloft, and also a certain amount of geopolitical risk. You can still have shortfalls by acute events, even in a time of chronic risk. So when we go into the front of next year, though, you have seasonal weakness, and you'll see demand softening anyway at a time when inventory builds will be read by the market extremely bearishly. So what do you do about it? Well, I think, there's going to be producers who are going to do better or worse depending on the price. Differentially, when we see oil moving to the downside, 65 to 70 with room to travel up still this year, but next year 60 to 65 with room to the downside on trade. So I think that the second half is really, you've got seasonal strength helping you a lot.
Kevin, I'm worried that the hedge here is to start investing in restructuring bankers, though, no?
Well, I mean, part of what Phil LeBeau said is also what I would keep in mind. We're all watching China right now, but don't forget the EU trade story. This is a multifaceted demand-side destroyer, and it could show up later in the year. We're talking 4Q. So when you start thinking about when it's time to refinance and restructure debt towards the end of the year, you could have an even worse environment.
Okay, let's talk currencies, Joe.
Yeah.
What are you doing?
Well, yesterday's move was primarily
You're always looking at these sort of interesting connections.
I tried to. Yesterday's move was primarily a surprise. I think the tariffs took everybody
by surprise,
off the back foot. Nobody really expected this. So you have the dollar reacting immediately because this looks like, well, maybe the Fed will lower rates more. But it's really a global trade story what's going on here, as everyone has said, because it really is true, that whatever effect this has on the United States and its economy will be ramified all the way around the world. There are many other economies in the world that are much more dependent on trade than the United States. So although the immediate reaction was, oh, the dollar got sold a little bit, right, if you look ahead, whatever the Fed does will be either duplicated or envied by other central banks. They're only going to do one thing. They're going to be cutting rates or providing more liquidity in a case like the ECB where they really can't cut rates anymore, or the Bank of Japan because their main rate is already negative. So in that situation, you have the U.S. economy is still in better shape than everyone else. That's one. You also have something on the Chinese side, which, of course, is Hong Kong. So I was thinking after I heard this news, why would the president choose now to put on tariffs? Well, his goal is a trade deal with China. China may be under more pressure than is obvious in the economic sense because of Hong Kong.